All right, everyone, let's go ahead and get started. My name again is Richard Fetchko. I'm the CEO and founder of Altfins, and I welcome you to lesson 9 of the 10 lesson webinar. And this one is perhaps the most important one of all because it deals with risk management. And we'll go over some risk management techniques. I will also share a tool, an Excel spreadsheet for you to use to figure out your stop loss levels, the size of your trade, and so on. And hopefully these techniques and tools will keep you in the game long enough to learn and gradually get better at trading and keep you in the game. One of the things that's important to realize when trading is that trading is probabilistic. I think I've used this term before. What that means is that even if we have a certain edge in the market that gives us 65 or up to 75% success rate, that still means that we will be losing money on 25 to 35% of the trades, and we have to accept that and prepare for it and manage the risk. But also what that means is that to realize that let's say 70% success rate over time, it's not enough to do 10 trades. It really requires many, maybe 100 plus trades over time for that statistic to play out, right? So what that means is that you really need to do, and we really need to do, lots of small trades. Don't bet the farm on any given trade, no matter how much you love it. You may increase the size of the trade slightly, but ideally you stick to the size of the trade across all the trades that you do. And that way, not only you manage your downside risk, but you also increase your chances of realizing that success rate of 65 to 75% because you're going to do lots of small trades. And also psychologically, especially in the beginning, doing big trades puts a lot of pressure on yourself, on your psychology, on your mindset. It puts a lot of pressure and hastens certain decisions or forces bad decisions as well. So I think doing small trades, particularly when we're learning, helps us basically you follow the guides, follow the steps and the rules that we set out, and not be emotional about any given trade. And so the key is to really keep your losses under control. Some traders say this is the most important lesson and the most important rule they have. Keep the losses small. That way that helps them stay in the game for the long term, which helps them then realize over the long term the success rates that statistically should work out or play out. The other thing I suggest is to keep a journal of your trades, the reason you entered the trade, what was the setup, what was the pattern, where would you, what was the target, and where was the stop loss. That it helps if you connect the Altfins platform with your exchange account with an API, because you can see the trades then in the charts, right? So an example would be one of the trades that we did, right, was cello. And if I go to the chart and say, show my trades in chart, then I can see my trades here, right? The other thing you can do, and I do sometimes as well, or I try to, is that when you go to your portfolio, you can actually add notes to your transactions. So for example, here cello, here right here, down here, as you can see, is a little tool that allows you to add a note and say, bought, what was it? I think at the time it was a pullback in uptrend near support level. I think it was about $6 at the time. Target get price of $8 and stop loss at $5 and I think 10 cents or so. Okay, so once you save this here and you go to the chart again, whether it's on the it could be under the trade tab or it could be on the screener tab, then you should see this note. Well, there we go. Okay. I actually added the note to the wrong trade because I added the note to the trade where I sold it, not bought it, but you get the point. As you can see now, there is a note here that basically says pullback in uptrend and so on and so forth, right? And that helps me if it were ideally it would be in the notes for the transactions where I bought it, and that would be a reminder of what I did, what was my target and so forth. So if you want to keep this journal in an Excel spreadsheet, that's fine as well, but certainly keeping one will help you learn from past mistakes and just keep a tab on your trades as well, especially if you're doing tens and tens of trades at the same time. Now, these are just small tools to help you with that, but here are the big important things. One is proper position sizing. You ideally really want to do small trades, like I said, to keep you in the game if there's a downturn like today, if there's a prolonged downturn, and to keep you around in the game for when the market turns around, right? You don't want to blow your entire portfolio within a few weeks, and because you were betting half of the portfolio on every position. So how do we set the position sizing appropriately? Most of the traders out there follow the rule of not betting or not risking more than 1 to 2% of the portfolio equity. Portfolio equity meaning the value of your portfolio. Okay, so let's, I actually have an Excel spreadsheet that I share with you here. Here's the download for that. There's download link that will be in these slides, and I'll send these slides to everyone. And but in it you will find an Excel spreadsheet that looks like this. And that will basically says, hey, what's your portfolio value? It's about $17,600 right now. What is your desired risk per trade? Let's just say I want to just risk 1%. So what does that mean? Well, if I'm willing to risk at most 1% of my portfolio, then that means each trade can only lose $176 or $180 per trade. Okay, what does that mean? Well, if let's go to a real example here. I think I used Chainlink. Let's take a look at Chainlink. All right. So nice. It's actually in a strong uptrend across all 3 time horizons. This is actually a very interesting potential trade. The price is pulled back clearly now to the $30 level, which appears to be a decent support level. Even better is the 200-day moving average right here at $27. Okay, so let's just say we were going to enter this trade, at $30 on this pullback, let's say our bet would be that it bounces off of the $30 level, and my target would be about $35, which is the next resistance level. All right, so link $35 is my target price, and based on that, there's a formula here that says if your risk to reward ratio is 1 to 2, then your stop loss price should be about 27.50. 27.50 is actually just above the 200-day moving average. I might move it actually a little bit below that, because I think that it might quite well bounce off of that. But point being is, if this were how I set up the trade, my downside is 8%. That means my trade size should be about $2,000. If I go with $2,000 and things go against me and I lose maximum of 8%, well, 8% of the $2,000 is about $170. Right? So that's your risk per trade, and that's what dictates the trade size. So if I go back to the presentation, in fact, on the next slide, the proper position sizing, there's a few variables that have a bearing on it. One is the portfolio value, the risk per trade. Like I said, we changed it to 1%. And then also your stop loss distance. That dictates how big is your trade size, right? In this case, $2,000. In this case, $1,300. So this Excel spreadsheet will help you with that. But in order to do that, you do have to upfront determine what do you think is your target price or upside level, and what is, and therefore that will determine what's your stop loss price. So that's the other important tool is around the risk reward ratio. We talked about this when we discussed the trading range or trading ranges strategy, where we basically were trading between the support and resistance line, and we can use this for most of the other trade setups as well. And I think that a reasonable minimum risk to reward ratio is 1 to 2, meaning for every 1 unit of risk or $1 of risk, let's say, for every $1 of risk, I need potential $2 upside. Okay, and again, we can demonstrate it right here on the link example. If I think that my target is here 35, I think that's where the price can swing back to when it bounces off of 30. If that's my target and my entry level is 30, right, then my stop loss price is 27.50. And that's basically, right, if I enter at 30, then I'm losing 250 potentially. If I do that, 27.50 minus 30 is 250. If I add some additional decimal places. So that's my downside per unit, and my upside is my target price minus entry price of $5. So the downside is 250, my upside is $5. So that's your 1 to 2 risk to reward ratio, RRR. Okay, and keeping this risk to reward ratio means that that even if we are 35% of the time right, we are going to be at least breaking even. And if we are right 50% of the time, we're going to be making money. And if we are right 70% of the time, we're going to be making a lot of money. Okay, but of course these target prices have to be realistic, right? I can't just say, yeah, my target price is 45. All right, I suppose you could, but is that realistic? So I think the realistic target is 35, and that really dictates my stop loss level, or based on the 1 to 2 risk to reward ratio. So this is also critical, which is setting or determining the downside risk and the upside reward upfront before you enter the trade. Where do you think the price can go to? And therefore, if I'm wrong, where do I get out of this trade before it, saves me from some catastrophical, sort of real negative situations and circumstances and outcomes. Sometimes it's painful because it gets me out of the trade too early, because price perhaps dips and then turns around. It happens, but also it saves you a lot of terrible situations, really big drawdowns that could wipe out a big portion of the equity, even with the small trade sizes. But getting the trade sizes small is a big help to begin with. Keeping the risk reward ratio 1 to 2 is also an important technique and a tool to manage your risk. And then there's a few other things, such as gradual entry for breakouts. So we discussed in the prior lesson and the lesson prior to that, especially when you are playing the breakouts, like pattern breakouts, like ascending triangle breakout, or key level breakouts, like resistance level breakout, there's a lot of fake outs, a lot of failed breakouts, and those can cause a lot of headache. And so it's good to gradually react to the breakout. So this is the lesson. Let's see, let's pull up the lesson 8 slides. And so by gradually getting into the position, we don't overreact. Here's an example, or perhaps, yeah, this one. So the breakout happens. You could put half a position on the breakout. Oh, sorry, actually, that was in the lesson 7, but it applies here too as well. You could enter half a position at the breakout and then half a position at the pullback after the breakout, or some confirmation, or even a later stage of the breakout, which is, okay, there's a pullback and then the price once again breaks above that, right? So first entry could be here at the breakout. Second entry could be here at the pullback. So, or that could be also your first entry if you want to be really conservative. And then the third or the second entry could be when the price actually confirms the breakout by moving above the local high. So the point being that even with this technique of gradual entry into the for the breakout patterns or the breakout trades, you could also manage to reduce your downside risk, because you want to go all in right at the breakout, which oftentimes have fake outs or failures. Also, when you exit the trades, you can also do it gradually, meaning you can book part of the profit halfway to your target. So if I go back to cello, may or may not remember, but we, on the exit, we I exited in 2 tranches. So one, I sold half of the position at 764, and then the other half position I let it ride and I sold it at 780. So getting out of the trades, maybe you have a target of $8, you take half of the position. If it's in the money, if it's making money, you take half of the position off perhaps as it approaches your target, and then you let the other half ride. And if the other half doesn't reach your target and comes back, then you still sort of break even. So that's another technique to manage your risk on the exit. And then using the stop loss orders, as we demonstrated already, it really depends on the strategy as to where do we put the stop losses. Could be placed just above the last swing low. So an example, I think example is actually here in the lesson 8 for the ascending triangle. Stop loss should be placed at the approximately last swing low. Now, if this stop loss happens to be lower than your risk to reward ratio would dictate, meaning this Excel spreadsheet, you kind of need to sync them up and decide which one you use. But basically, ideally the last swing low is higher than your RRR would dictate. Perhaps the RRR would dictate that, hey, you could get out here and the last swing low is here, then you could go with the RRR. So a little lower actually, to give that trade a little more room for error. So in this slide, I basically explained the proper position sizing, which we used the Excel spreadsheet for. We're going to use it again in a minute. The risk reward ratio as well. Here, I have this slide that kind of summarizes the trade strategies that we've gone over so far, and sort of summary, what is the trigger for getting in, what is the trigger for getting out, and what determines the stop loss. Usually it's the risk to reward ratio. In other cases, you could also use the swing low or the nearest support, whatever is more conservative. Or I guess the minimum would be using the RRR ratio. If the swing low is a bit higher, you can choose the swing low. I would still probably stick to the RRR ratio. For the most part, ideally, those two things oftentimes actually line up. But here you have it. That's kind of a cheat sheet. We're gonna look at a few trades that we did and where we did actually put the stop loss. So for example, here, new cipher. This is a pullback in the uptrend trade that I believe is still active. So if we take a look at it, right? Yep, here it is. We bought it at about $1.35. The idea was that it had a big spike. It was coming back down. The rate of declines was declining, flatlining, although it wasn't complete bottom just yet. But I did think that $1 was a solid support level, which it's broken through below that, so it didn't quite pan out. But if it still hasn't reached my stop loss level. Stop loss is at 70 cents. And how did I get to that? Stop loss calculation. Oops. I did that by saying, okay, my entry price was $1.135. My target price was $2. That's where I thought that the price could swing back to. And that basically, with the 1-to-2 risk to reward ratio, dictates where my stop loss would be. and that's where I placed it. And we're still above that, so the trade is alive, and I won't close it until I either win or I lose. In any case, the trade size with a 2% risk per trade allowance, my trade size is about $1,000, which is exactly how much I placed on the trade. Okay, so again, this Excel spreadsheet helps a lot with determining your trade size, your stop loss, and so on. The other trade, we already reviewed this one, Cello. This one is nulls. We did that in the last lesson, which was approaching ascending triangle. Let's take a look at it. I'm sure it's not working out right now with the big pullback that we had today and partially yesterday. But here is the ascending triangle. Right here. So that was my support trend line, and the resistance trend line was around 70 cents. And we did the trade, or I did the trade here at 575. And the assumption was that this was an emerging ascending triangle. So this was not a breakout, an emerging ascending triangle that assumes that the price has been bouncing between these two trend lines, gradually rising, indicating that the buyers were more and more anxious to buy it at higher levels every time it pulled back off of the resistance level. And so the assumption was that once again, we would experience a bounce back to the resistance level. It hasn't clearly played out yet, but more importantly, where did we set the stop loss? And what is our position size? Well, with the 2% risk per trade, and at the time, approximately $19,000 in portfolio value, and the target RRR 1 to 2, we entered. The entry price was 0.575. Like I mentioned, the target price was basically my resistance level, which it usually is, and that basically dictates my stop loss price using the 1 to 2 risk to reward ratio. Spits out 51 cents or so, which actually, even psychologically, 50 cents seems like a decent support area. In fact, if you look at the chart, right, and if you look at where have we seen some recurring touch points on the support level, we zoom out a bit, 50 cents has seen some decent action. So 50 cents is about right here. It's acted as a support level on multiple occasions. In some cases, it was a resistance, but really, so there is good case to be made that that's my kind of the downside. If it breaks below that, then we're out of the trade, and that's where we place the stop loss, actually just below the 50 cents level. So it's not exactly where the RRR would dictate, but it's very close to that. All right, so let's go ahead and take a look at the market today and practice using the Excel spreadsheet and looking for some interesting trades. With the pullback today, I think a couple of interesting strategies come to mind. One is oversold in an uptrend. If you remember that strategy, I have it saved here, so I can go ahead and apply that. Wait, that's oversold in an uptrend. I meant to say pullback in an uptrend. Pullback in an uptrend, my bad. And I want to use, we had a couple of different versions. I'm going to use a simpler version. which gives me 54 items or 54 coins, not surprisingly. So these are coins that are in an uptrend across all three time horizons right here, and also have a market cap above 5 million, and the weekly performance is under 5%. Okay, I could further modify it and say, okay, well, considering today's action, I may want to say it's not a 5% pullback, but even more than that, maybe 10% pullback. Okay. All right, they're still in an uptrend, but they have more than 10% pullback in the last week, mind you. Okay, not today, but in the last 7 days. So we've got Ethereum here, Luna. I mean, we've got some even link chain, right? So we've got some decent names here on the list, well-known names. Let's take a look at Algorand. So clearly an uptrend across all three time horizons thus far. Big pullback today. You know, are we getting close to some reasonable support level is kind of what we need to determine. All right, hypothetically, yeah, 175 maybe. Ideally, we actually line it up with the 200-day moving average to really make it a more robust support level. V-chain, not really there. Let's take a Luna. Take a look at Luna here. No, not pretty far from it. Although a beautiful uptrend. It really looks like just a solid pullback to the 50-day moving average. I mean, I really like this setup actually. In terms of the support levels, I'd say the closest robust support level will be about 40. Right, there was one at around 45 perhaps. That was a resistance level a few times that was broken. So we're at that maybe 45 or so dollar right now, 44 and change. Okay, so I'd probably put a trade if it touches 40 or so, I'd go long here. But let's hypothetically say that that's the case. I can put a buy limit at that level today, and if it does get there, then I'll get filled, and then I'm long. Then I would be long Luna. But let's just say we have a 1%. Let's just say 2% risk per trade, so I can risk up to $350 per trade. I have a 1 to 2 target risk to reward ratio. This is Luna. So I would enter at $40, I believe. That would be my, let's just say slightly above it, $41. My target price, if I bought it here, sort of the nearest support resistance level is 45, sort of a robust one. I mean, I could be more modest and look for $45, I suppose, but I think $50 is not unrealistic in this case. In which case, my stop loss price would be about $36.50, and $36.50 would be somewhere here. All right, so that would be my stop loss level. It basically lines up with this low here on the swing low here, and it's probably reasonable enough to give. I would probably set it just slightly below that because I can see that level as being an okay support level in the past. So I don't want to lose out on this trade right on the support level. I'll probably set it at 35 or so, so slightly below that. But it's still in line approximately with that risk to reward ratio. All right, and my trade size would be $3,200 based on the portfolio size and the downside risk that I'm willing to take. I could actually go with a $3,000 trade. So that's how you would use that situation. Let's go ahead and take a look at the other one. Let's open up a new tab here. The other interesting filter or screen right now could be the one that I actually mentioned, that oversold in an uptrend. So basically, again, looking for coins that are in an uptrend on a medium and the long-term basis, but the relative strength index is below 40, which for coins that are in an uptrend below 40 is actually a rather oversold situation. Normally below 30 is considered oversold, but again, for upward or coins in an uptrend, even crossing below 40 is already, coins in an uptrend rarely cross below 30, but already below 40 is a decent pullback or a decently oversold situation. And we've got a few options here. Let's take a look at Matic, Polygon. So in this case, the medium and the long-term trends are still up. The short-term is down, which is okay. The short-term trend can oscillate or change rather quickly. I think the more important indicator is the medium and to some extent long-term trend. As you can see, even the 200-day moving average is nicely sloping up, right? The 50-day moving averages as well, but that's less important. And what I like about this situation, like I mentioned, the RSI is almost at 30, in fact, so that's quite oversold. And typically, when you've had such oversold conditions nearing support level, you at a minimum get a decent bounce back. And so in this case, the support level is around 150. Let's go ahead and draw that. It was a support level here and the resistance level a couple times here, as well as here, right? You could argue there was also a resistance level at 175 or so, but that's neither here nor there right now. That's not important. So 150, and what I like about this is that it's really close to the 200-day moving average. And that serves as another support level and really makes this support zone a more robust support zone at 135. So here, I would probably place a trade for 150 limit buy. And if that's the case, I do think that my upside is about $2, sort of the nearest resistance level, plus or minus, could be a little higher than that, but if I don't want to be greedy, I'd say $2 is realistic. So let's see what our Excel spreadsheet spits out. Right, 2% per risk per trade stays the same. My RRR stays the same. These things don't really, once you set them, you rarely change them. Matic, we said that 150 would be my theoretical entry price. My target price would be $2. Therefore, my stop loss price would be $1.25, which is about 17% lower, with a trade size of $2,100 approximately. So let's see, 125 would put me just below the 200-day moving average, which I like that. That means I still have a chance to salvage the trade, or I could still have a chance that the price bounces off. From the 200-day moving average, even if it breaks breaks below the 150 support level, it will encounter another support level at 135, which is the 200-day moving average. And then if it breaks through that, then I'm gonna get stopped out at 125. So that's the thought process. We can go ahead and implement that with Matic, right? I mean, today, if you believe that we're still in the bull market, which I do, is a very interesting day, opportune time to look at some situations. So here we are. As we said, we want to be put in a limit buy because it's not quite at 150, it's at 160. And today the low was 156. So I'll put it limit price at 150.51 or 2, let's say, a little higher than 150. And the quantity is dictated by my Excel spreadsheet. If I want to have a $2,000 or approximately $2,000 trade size, I need 1,400 units. Okay, so that shows me here that that's valued at about $2,000 or $2,100. And I'm going to go ahead and send it. Lack of funds. That's right. I have, I believe, pretty large BNB balance because I was staking it. But so don't want to pull that out yet. So let's just go with a smaller trade size for now. So that will be $1,300 worth. So I need to really have half that size for now. All right. Normally I would make some funds available to make this trade work, but I don't want to waste the time on that right now. But more importantly, the stop loss, I want to put a stop loss at, as we said, we want to get out at 125. If all hell breaks loose and we break through the 150 support and we break through the $135 200-day moving average support, then our Excel spreadsheet using a 1-to-2 risk to reward ratio dictates that we need to get out at 125. So I want to put all 100% of my position. Oh wait, I'm not in, right. I'm not in it yet. So I won't be able to actually place this position yet until I actually get in it. So, but that's basically, I would basically say the limit price is 125. Let's make it 124 and the stop price 125. All right, and here I would have the 800 units that I'm looking to buy, my open orders right here, 800 units. So once this buy order goes through, then I can place the stop limit sell order at these levels. All right, guys, well, that's really most that I wanted to sort of cover. I'm curious if there was any questions. If not, we can probably wrap it up. I hope that these techniques will help you succeed in your trading. Again, I'm going to share the Excel spreadsheet. It will be included in the link in a couple of these slides. So, so be sure to download it and make it your own. Put in your portfolio value, put in your 1 to 2% risk per trade, and so on and so forth. Start using it. It will help you really be more consistent with each trade in terms of the trade size and the stop loss levels. Great. Well, it's been a pleasure, and we'll see you on Thursday for lesson 10 when we'll discuss margin trading and shorting, which is actually in itself a risk management strategy potentially as well, is shorting coins that will protect you when the market turns down. You will actually make money on the shorts. Of course, nothing's for free. There's downside to that as well, but it is in itself a trading strategy that could certainly generate profits in the down market, but also protect you from big drawdowns if you have a more balanced long and short portfolio. So we'll cover that on Thursday. Enjoy your day. Good luck trading. Thank you.